This LOS is described types of debt issued by corporations. Corporate debt. The first thing that we're going to look at is bank loans and syndicated loans. A bilateral loan is a loan from a single lender to a single borrower. A syndicated loan is a loan from a group of lenders called a syndicate to a single borrower. Most bilateral and syndicated loans are floating rate loans, and the interest rate is based on a reference rate plus a spread. Next, we'll look at commercial paper. Commercial paper is a short-term, unsecured promissory note issued in the public market or via private placement that represents a debt obligation of the issuer. Commercial paper was first issued in the United States more than a century ago. Commercial paper is a valuable source of flexible, readily available, and relatively low-cost short-term financing. It is a source of funding for working capital and seasonal demands for cash. It is also a source of bridge financing, that is, interim financing that provides funds until permanent financing can be arranged. The combination of short date maturity, relatively low credit risk, and a large number of issuers make commercial paper attractive to a diverse range of institutional investors, including money market mutual funds, bank liquidity desks, corporate treasury departments, and institutional investors that have liquidity constraints. Most commercial paper investors hold their position to maturity. So just put in a quick little practice question here just for fun. A loan made by a group of banks to a private company is most likely A, a bilateral loan, B, a syndicated loan, or C, a securitized loan. Okay, just put that one in because to remind you that it's very important to get up to speed on all the definitions. And again, where's a good place to be reviewing is the summary at the end of each reading and the glossary, okay, to get all these terms correct. So B is correct. A loan from a group of lenders to a single borrower is the syndicated loan. A is incorrect because a bilateral loan is a loan from a single lender to a single borrower. And C is incorrect because securitization involves moving assets such as loans from the owner of the assets into a special legal entity. So continuing with the commercial paper here, and so I made a little note here. I said, note, the LOS does not say to calculate. However, they have an example between the US commercial paper and the Euro commercial, okay? Note that the US is sold at a discount and Euro commercial paper is interest bearing. So that's a 5-star key differentiation point. So here we just have a little table where we've got the feature and we've got the US commercial paper in the first column and the Euro commercial paper in the next. So in terms of the currency, US commercial paper, of course, US dollar. Euro commercial paper is in any currency, okay? It's not just the Euro currency, it's any currency. Again, it's like a Euro bond, we're calling it Euro commercial, all right? Maturity, this is important. US commercial paper overnight to 270 days, but the Euro commercial paper is to 364 days. So you know that you could make a lot of multiple choice questions, most likely, least likely, based on some factoids from this table. And very important here in terms of the interest, US commercial paper is sold at a discount basis, but the Euro commercial is interest bearing, okay? Settlement, again, some differences. The US commercial paper is T plus 0, it's trade date, cash settled, where the Euro commercial paper is T plus 2. And negotiability, US commercial paper can be sold to another party, and similarly, Euro commercial can also be sold to another party because that means they're both very liquid. A quick little practice question here. Euro commercial paper is most likely A, negotiable, B, denominated in euro, or C, issued on a discount basis. Now that question should be easy because we were just reviewing the table. Nevertheless, this shows you that if you get this type of question on the exam, you have to be up to speed on all your little factoids, okay? So A is correct. Commercial paper, whether US commercial paper or Euro commercial paper, is negotiable. That is, investors can buy and sell commercial paper on secondary markets. Of course, B is incorrect because I said Euro commercial paper can be denominated in any currency. And C is incorrect because Euro commercial paper is more frequently issued on an interest-bearing or yield basis than on the discount basis. Continuing with corporate debt, we're now going to look at corporate notes and bonds. So the first thing that we're going to look at is maturities. So short term refers to original maturities of 5 years or less, okay? Intermediate term to original maturities longer than 5 years and up to 12 years. So an intermediate term is 5 years to 12 years. And long term is to original maturities longer than 12 years, okay? Now that's important, I put that in bold because sometimes we would think that intermediate is 5 to 10, but in this case, the official definition is 5 to 12, okay? So those securities with maturities between 1 year and 12 years are often considered notes, whereas securities with maturities greater than 12 years are considered bonds. It is not uncommon, however, to refer to bonds for all securities irrespective of the original maturity. That's true. So, we're going to say it's a 5-year bond, a 7-year bond, an 8-year bond, but that's just a little bit of, nitty-gritty on the terminologies. Next, we're going to look at the coupon payment structures, and we've looked at this a little bit in previous LOS, but a conventional coupon bond that pays a fixed coupon during the bond's life, okay? Bonds for which the periodic coupon payments adjust to changes in market conditions and or the issuer's credit quality. There's coupon payments can be made quarterly, semi-annually, or annually, depending on the type of the bond and where the bonds are issued and traded. And zero coupon bonds, of course, pay no coupon. Deferred coupon bonds pay no coupon initially, but then offer a higher coupon. So payment in kind coupon bonds make periodic coupon payments, but not necessarily in cash. The issuer may pay interest in the form of securities, such as bonds or common shares. Now, we did see in terms of different coupon payment structures in a previous LOS, so this should be a review. It should be nothing new. So we'll do a quick practice question. A U.S. investor who purchases an option-free bond with a 7% coupon rate maturing in 20 years and issued by a U.S.-based company is most likely exposed to A, volatility risk and credit risk, B, event risk and interest rate risk, or C, volatility risk and yield curve risk. Okay, that one might have been a little bit tricky, but not too bad. So the correct answer is B. The investor faces event risk in a corporate bond and interest rate risk in a long-dated fixed coupon bond. So the interest rate risk is always there, okay? The volatility risk was the wrong one. So continuing with our corporate debt, now we're moving into the contingency provisions. And again, we've looked at this in a previous LOS, so this should be a little bit of review, not new to us, okay, if we're doing things in order and in sequence. So the three commonly used contingency provisions are call, put, and conversion provisions. Callable bonds give the issuers the ability to retire debt prior to maturity. Because the call provision is a valuable option for the issuer, investors demand compensation ex ante, that means before investing in the bond. Thus, all other things equal, investors require a higher yield and thus pay a lower price for a callable bond than for an otherwise similar non-callable bond, okay? So remember, the price of a callable bond equals a normal bond, option-free, minus the price of the option because the issuer has bought the option from you, okay? That's a review. We did that before. Puttable bonds give the bondholders the right to sell the bond back to the issuer at a predetermined price on specified dates before maturity. Most puttable bonds pay a fixed rate of interest. Because the put provision is a valuable option for the bondholders, puttable bonds offer a lower yield and thus have a higher price than otherwise similar non-puttable bonds. And we saw that. The price of a puttable bond equals the price of a normal bond plus the price of the option because you're buying that option, you're paying for that option, okay? And we saw that in a previous LOS. So a convertible bond is a hybrid security that lies on a continuum between debt and equity. It consists of a long position in an option-free bond and a conversion option that gives the bondholder the right to convert the bond into a specified number of shares of the issuer's common shares. And we saw the conversion ratio in the previous LOS. So again, this review with this slide with regards to contingency provisions should be a review. Okay, quick practice question on corporate debt. Corporate debt securities that are offered continuously to investors by an agent of the issuer are best described as A, range notes, B, structured notes, or C, medium-term notes. The correct answer is C. The unique features of medium-term notes are that they can be offered continuously over a period of time to investors at maturities desired by the investors. Okay, I want to again just go into the text to show you that we just did a quick practice question on corporate notes and bonds, and there was a question there about medium-term notes being offered continuously, and that was a little bit buried in the text, okay? So so one of the nice things about the ebook at least is that I say, oh, where is that? So what I did is I did a search here, and I put the term medium and continuously, and then I found the paragraph quite quickly, where that was buried in the text. So one of my study tips is that when you get a question wrong, go in and find out where it is in the text and go back to the text and find out where it is. And if you're using the electronic book, use the search for functionality. So you can see here, it highlighted here, that the medium-term market can be broken into 3 segments. Short-term securities that carry floating or fixed rate, medium to long-term securities that primarily bear a fixed rate of interest, and structured notes. Medium-term notes have the unique characteristic of being securities that are offered continuously to investors by an agent of the issuer. So there it is. I can highlight that, and it's buried in the text, and there it was, okay? So I just again wanted to show you that with that last practice question, if you didn't get it right or said, hey, where did that come from? Is that in the text, really? We'll go in and find it, and it's there. And so many questions on the CFA exam are from factoids and little points buried in the text. I always say it's important to go back to the curriculum if you've got a question wrong and find out where it is. And you won't get it wrong a second time, hopefully. Another quick practice question. An investor fears that economic conditions will worsen and the market prices of her portfolio of investment-grade corporate bonds will decrease more than her portfolio of government bonds. The investor's fear is best described as a fear of A, default risk, B, downgrade risk, or C, credit spread risk. Okay, that's a good one. C is correct because when the market is willing to pay less for investing in risky bonds, the spread on those bonds widens relative to the default-free bonds. Thus, the investor is concerned about credit spread risk. So now we're looking at structured financial instruments. We're moving into corporate notes, and we're looking at structured financial instruments. So the first structured financial instrument that we're going to look at is capital protected instruments. So suppose an investor has $100,000 to invest. The investor buys zero coupon bonds issued by a sovereign issuer that will pay off $100,000 1 year from now. Also, suppose the cost of buying the zero coupon bonds is $99,000. The investor can use the $1,000 left over from the purchase of the zero coupon bond to buy a call option on some underlying asset that expires 1 year from now. Okay? So buying a call option gives the investor the right to buy the underlying asset in 1 year at a predetermined price. The investor will receive the $100,000 when the zero coupon bond matures and may also gain from the upside potential of the call option, if any. This combination of the zero coupon bond and the call option can be prepackaged as a structured financial instrument called a guarantee certificate. The next structured financial instrument that we're going to look at is the yield enhancement instruments. Yield enhancement refers to increasing risk exposure in the hope of realizing a higher expected return. A credit-linked note, CLN, is an example of a yield enhancement instrument. Specifically, is it a type of bond that pays regular coupons but whose redemption value depends on the occurrence of a well-defined credit event, such as a rating downgrade or the default of an underlying asset called the reference asset. If the specified credit event does not occur, the investor receives the par value of the CLN at maturity. But if the specified credit event occurs, the investor receives the par value of the credit-linked note minus the nominal value of the reference asset to which the CLN is linked. So a CLN allows the issuer to transfer the effect of a particular credit event to investors. Thus, the issuer is the protection buyer and the investor is the protection seller. Investors are willing to buy CLNs because these securities offer higher coupons than otherwise similar bonds. In addition, credit-linked notes are usually issued at a discount. Thus, if the specified credit event does not occur, investors will realize a significant capital gain on the purchase of the CLN. On this slide, we're looking at two more structured financial instruments. The first one is participation instruments. Most participation instruments are designed to give investors indirect exposure to a particular index or asset price. For example, investors who are precluded from investing in equity directly may get indirect equity exposure by investing in participation instruments that are linked via a formula to the performance of equity indexes. Many structured products sold to individuals are participation instruments linked to an equity index. In contrast to capital protected instruments that offer equity exposure, these participation instruments usually do not offer capital protection, okay? So that's an important point. The next structured financial instrument that we're going to look at is the leveraged instruments. And leveraged instruments are structured financial instruments created to magnify returns and offer the possibility of high payoffs from small investments. Now this is important in this section. An inverse floater is an example of a leveraged instrument. As the name suggests, an inverse floater is the opposite of a traditional floater. The cash flows are adjusted periodically and move in the opposite direction of changes in the reference rate. So when reference rate decreases, the coupon payment of an inverse floater increases, okay? So a general formula for the inverse floater's coupon rate is the inverse floater coupon rate equals C minus L times R. So we're just going to finish this LOS with two practice questions. The first one, if interest rates are expected to decline, an investor can earn a higher coupon interest rate by purchasing A, a callable bond, B, an inverse floater, or C, a floater with a floor. Okay, that question shouldn't be too bad. The correct answer is B. If interest rates are expected to decline, investor can earn a higher coupon interest rate by purchasing an inverse floater, okay? Inverse floaters have a coupon formula such that the coupon rate increases when the reference rate decreases and decreases when reference rate increases, okay? So the coupon rate moves in the opposite direction from the change in the reference rate. And one last practice question to finish this LOS. A structured financial instrument whose coupon rate is determined by the formula 5% minus bracket 0.5 times LIBOR is most likely A, a leveraged inverse floater, B, a participation instrument, or C, a deleveraged inverse floater. Okay, I think this is a really excellent question to end on because I think it's a little bit harder, but not impossible. And it's one of these things that you just got to know, okay? So the correct answer is C, a structured financial instrument whose coupon rate is determined by the formula 5% minus bracket 0.5 times LIBOR is most likely C, a deleveraged inverse floater. So C is correct, a structured financial instrument whose coupon rate moves in the opposite direction of the reference rate is called an inverse floater, okay? But because the coupon leverage 0.5 is greater than 0 but less than 1, the structured financial instrument is a deleveraged inverse floater. In this example, if the reference rate increases by 100 basis points, the coupon rate decreases by 50 basis points. So remember, a general formula for the inverse floater's coupon rate is the coupon minus brackets L times R, okay? So that was a nice question to end on, a little bit tricky, but a good one. And that's the last slide for this LOS. Thank you.